looking at all of those pieces, like the rising HOA fees and rising insurance costs and climate issues, I think one of the biggest mistakes is thinking of those costs separately. The truth is that they are all connected, at least to some degree. They're all feeding into this one big affordability problem that we have in the US, and it's a really big deal.
Welcome to Sustainability Leaders. I'm Michael Torrance, Chief Sustainability Officer at BMO. On this show, we will talk with leading sustainability practitioners from the corporate, investor, academic, and NGO communities to explore how this rapidly evolving field of sustainability is impacting global investment, business practices, and our world.
The views expressed here are those of the participants and not those of Bank of Montreal, its affiliates, or subsidiaries.
Welcome back to Sustainability Leaders. I'm Alma Cortés Selva, Senior Advisor at the BMO Climate Institute. The cost of homeownership is changing beyond mortgage rates. New LendingTree research shows that HOAs are rising rapidly, while climate risk and higher insurance premiums are adding new affordability pressures. Together, these trends are influencing where people can afford to live and creating broader implications for lenders, insurers, and investors. Joining me today is Matt Schulz, Chief Consumer Finance Analyst at LendingTree, to discuss what these trends mean for homeowners and the housing market. Matt, welcome to the show.
Thank you for having me.
Your data shows that nearly 1 in 3 homeowners in metropolitan cities pays HOA fees, with millions paying $500 or more per month. From a lender perspective or investor perspective, are these costs still being fully captured in underwriting, or are they an underappreciated source of borrower stress?
I think it might be a little bit of both, actually. I think that underwriting clearly captures HOA fees and kind of where they are today and likely assumes some growth going forward. But the issue is when those costs rise more than anticipated over a longer period of time. And that becomes a pretty big deal because these HOA dues are a significant thing for people. And it's something that I don't know that consumers necessarily grasp how significant they are either. And I think that there's a lot of talk about the overall cost of home ownership in about 100 different ways, but there's no question that HOA fees are something that need to be taken really seriously, both in terms of underwriting for the lender and investor perspective, but also from the consumer perspective too. It's funny, I always bring up the fact that one of the comfort TV watches that my wife and I have is House Hunters and House Hunters International, and the HOA costs appear in that sort of show as well, where they're talking about like somebody buying a condo on, the Florida coast or something like that. And then it's like, well, it's this per month, but then it's like $6,000 for a year for HOA fees. And when you see that sort of stuff, it kind of drives home just how crazy those costs can be and how people ignore those costs at their own peril.
Do you think that the HOA fees are a signal of deferred maintenance? How should investors interpret that when evaluating the quality of underlying housing assets or even a homeowner?
It's interesting. A cheap HOA isn't always a healthy one. And sometimes there are reasons why HOAs are expensive. And I think that the financial health of that HOA can be a pretty good indicator of the quality of that asset, just when you're looking at it from a lender or investor perspective. And I think that if an HOA has a pretty well-funded reserve, may be frustrating to consumers because they may feel like, why do they have all that in their pocket? Can they reduce our costs for a little while and give us a little bit of a break? But the truth is that when your reserves were well funded at an HOA, it suggests that the board is being proactive and it can position that property, that neighborhood better to withstand things that they may not see coming. So it's a significant thing.
We're also seeing in your research that some buyers are avoiding HOA properties. Do you think this could start creating a pricing divergence or liquidity differences between an HOA and non-HOA property?
I don't think there's any question that you have a significant group of Americans who are just like, I have no interest in an HOA property. They may even see the benefits of it in some ways, but they just don't want to deal with it. Or they may not see the costs as being worth it, or the amenities, or whatever the case might be. So I mean, I do think that the higher the HOA costs go, it can certainly affect demand for those properties and kind of tighten up who would actually be looking at them. And that has a real impact on how investors should look at that sort of thing. But I think that we're always going to see where there is a group of people who just don't want some of the drama and some of the extra costs and some of the just extra stuff that goes along with living in an HOA neighborhood or building. That's just a decision that they've made.
Shifting gears a little bit, we've talked about HOAs, but another big cost is rising insurance premiums. LendingTree research showed that 56% of insured homeowners have seen insurance premiums rising, and many are concerned about losing coverage. How material is insurance becoming, not just to affordability, but to housing risk, and how it's priced across markets?
Yeah, insurance is unquestionably becoming an affordability thing for consumers, for sure. It's just another one of those things that make a whole subset of Americans feel like they just can't afford to do this, and why are we even bothering? But it's also a market pricing issue. And anytime you're talking about something that affects the demand for housing in the way that these insurance premiums can, it's a significant thing.
I want to bring climate risk into this because I think it plays a big part into why we're seeing a high increase in insurance premiums. The data shows that 68% of homeowners are worried about climate risk, and then they're expecting this risk to worsen. Are we starting to see a shift where climate exposure is directly feeding into behavior and then ultimately credit performance?
Yeah, I think at a minimum, we're seeing borrower behavior changing because of climate risk. And, it's function of people maybe not wanting to buy along the coastline because of bigger hurricanes. But it's also it's not just along the coast. It's bigger thunderstorms. It's all those sorts of things in the middle of the country, and increased fire risk, and so many issues that go beyond just some of the things that we automatically think of, like bigger hurricanes and warmer water. So it's certainly something that borrowers are paying attention to. And it has to be something that investors and lenders look into as well, because if we see these climate risks continue to grow, it means more risk of more damage, of property loss, and all of that for these properties. And it's something that lenders and investors have to pay attention to.
Matt, what do consumers understand about climate change? Have their expectations changed? And then are they understanding it better because they're seeing some of the effects on their housing and on their own lives?
Yeah, I think some of it gets down to just the effects that they're seeing on their own lives. Maybe they're not reading papers on climate change, and they might even be skeptical in some ways. But when you see droughts that are causing wildfire issues, when you see historic storms, when you see other major issues that aren't just on coastlines, but are in the middle part of the country, that's the sort of thing that opens people's eyes a little bit. And what's interesting is that they might not even see it necessarily as climate change and may not understand kind of why it's happening, but they're seeing that these things are happening or have happened, and they are reacting and governing themselves in terms of where they would want to live and what they would buy accordingly.
Roughly 30% of homeowners have walked away from a purchase due to climate risk. Like you mentioned, like wildfire, like moving away from the coast or some other risk. From a market standpoint, does this suggest we're entering a period where valuation is increasingly tied to risk exposure and not just location or amenities?
I think that it's hard to kind of separate location from risk exposure in a certain way, because there are risks everywhere, but things look a little bit different in different places. And markets have always priced in risk based on location and other things. And climate exposure is just becoming another measurable factor that is playing a role in pricing. And I think that location matters, but it's something that is only going to continue to become more of a challenge for consumers to factor in when they're figuring out what they want to do, and also for lenders and investors to figure out how to manage, because the risks are real.
Finally, when you step back and then look across the trends, rising HOAs, increasing insurance cost, and then the growing climate awareness, where do you see the biggest blind spots for lenders, investors, policymakers?
Looking at all of those pieces, like the rising HOA fees and rising insurance costs and climate issues, I think one of the biggest mistakes is thinking of those costs separately. The truth is that they are all connected, at least to some degree. They're all feeding into this one big affordability problem that we have in the US, and it's a really big deal. And markets tend to care about the overall costs as opposed to the individual line items that we're talking about. And I think that how all of this stuff comes together is going to play a massive role over the next decade or more in what the housing market looks like for consumers and for lenders and investors. And the truth is that housing isn't getting expensive because of one thing. We talk a lot about interest rates, we talk about housing prices, just the sticker price for a home, but it's getting more expensive because of those things and lots of other structural things. It's a really big deal, and it's a really big challenge, and it's something that is hard to see how things get markedly better for consumers, certainly in the very near future.
Thank you, Matt. Very thoughtful on how you look at the multiple forces from HOA cost to climate risk and how they're converging to reshape the experience of homeownership, especially affordability. Thank you so much, and see you next time.
Thanks for listening to Sustainability Leaders. This podcast is presented by BMO. You can find our show on Apple Podcasts, Spotify, or your favorite podcast player. Press the follow button if you want to get notified when new episodes are published. We value your input, so please leave a rating, review, and any feedback that you might have, or visit us at bmo.com/sustainability leaders. Our show and resources are produced with support from BMO's marketing team and Puddle Creative. Until next time, thanks for listening, and have a great week.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.